Good afternoon. It's been a while, and boy, has winter just gotten suddenly cold. I am looking forward to April. Oh my goodness. But I hope your Christmas was good and your New Year's happy starting this year. So I want to talk about 2025. We are now a couple weeks into the new year, and one of the things that I have to laugh about is it's funny to tell people what you think's gonna happen a year from now, because rarely do we ever get things right like that. If you can't predict elections and ball games, this seems a little futile to me. So as I think about as an investor and as a financial advisor, as I think about, uh, 2025, the first thing I have to think about is the last 2 years, the stock market has gone up 25% and 20%. And rarely do we ever see 3 years in a row of really good returns. That's the first thing that I think about. Number 2, we were convinced, just 6 months ago that the Federal Reserve was gonna be lowering interest rates, into the end of last year, which they did, and into this year. That seems like now maybe not a real possibility for 2025. And more troubling to me about looking at this next year is the Federal Reserve has essentially lowered interest rates. The federal funds rate, which, by the way, is the rate that banks pay when they borrow money from the Federal Reserve, they've lowered interest rates 1 percentage point. However, the yield on a 10-year treasury has actually gone up by 1%, which frankly should never happen. Um, and it's troubling. When I think about why is that the case, the first thing I think about is the markets, and I believe the bond market has a mind of its own. The bond market believes that inflation is not going away, and I think more troubling is the reality that it doesn't seem like anybody from the government wants to deal with this debt. And, even President Trump, I think that, he would say that, "Oh, I'm concerned about reducing the federal debt," but he just recently, okayed or suggested that we not have a debt ceiling. That doesn't sound like someone who wants to deal with the debt. So as I look at 2025, the first thing I think about is bonds are not going to be, as, attractive as we once thought. Anything could happen. But so what we have decided to do, what I've decided to do with our clients is instead of owning 6-year maturity bonds in our bucket one, we are now thinking in terms of lowering our duration risk down to 2-year bonds. Ironically, they're yielding over 5%. And I think that from a safety standpoint, our bucket one of our bucket strategy says that bucket one should be safe money. And so a 2-year bond is a lot safer than a 6-year bond. And I'm talking about a bond fund. A bond mutual fund may own 1,000 bonds. They might have some maturities in 5 years and some in 6 months, but on average, they will. What we're looking for are bond funds that mature on average in 2 years. Now, I'm a conservative, which means I voted for President Trump, and a lot of people believe that the stock market's just going to go up, up, up with President Trump in office. I don't think you can make that assumption. Do I believe that he will be good for our country? I think he will be, especially as opposed to Kamala Harris. However, we live in a dangerous world in Russia and Ukraine, and in the Middle East, it's a powder keg. So that's one thing that could happen that could derail any um, big year for stocks. Number 2, obviously, is the Fed. If they don't lower interest rates, I think that's gonna create a headwind for the stock market. Um, and we don't know what will happen with, the border. We think that President Trump will, make big strides in closing off the border. but, he's gonna be met with opposition, and, I believe that we will see something on the border. I believe that we will see drilling take place in America, which will be good for consumers, but not for oil investors. Oil investors, if the price of oil drops from $80 a barrel to $50 a barrel, you're gonna love that at the pump, but if you're getting dividends from Exxon, you may not be nearly as happy with that. So, there are a lot of uh, uncertainties as we look at this year. Here's what I believe. I believe that we will see a positive year, but I think it will be more along the lines of 7% total return for the S&P 500. But I believe we're going to see at least a 20% pullback. Don't know when that's going to happen. So, let's say that the S&P is up 15% on July the 1st, and all of a sudden things start to get sticky in the fall and we see a 20% pullback. Well, now we're down 5 maybe in September or October, and maybe the market does come back, reverse those losses, and put up a 5 to 7% gain. I just wouldn't be, um, I wouldn't be setting my expectations at that 20% level. And let me just say, I hope I am wrong. I hope I'm wrong. Where can you invest this year? So if I'm retired, if I'm speaking to someone who is close to retirement or retired, I would own some bonds, but I would be owning 2-year bonds. I'd be owning short-term credit. I'd be owning maybe some floating rate. There are floating rate bond funds out that are paying 8% interest. In my bucket too, I want to own some, kind of 50% in stocks, 40% in bonds, and hopefully maybe 10 or 15% in gold. I am more convinced that gold is going to be a good asset to own over the next 10 years. And in your bucket three, I am absolutely believing that dividend paying stocks are always good to own, companies that increase their dividends. But I would also want to own some growth names, even if growth doesn't do as well this year. I can tell you that the issues with artificial intelligence, that's not going away, and it's making corporations more productive. And so I believe that AI is still a big story. I believe electric cars are still a big story. I am a big fan of Bitcoin. I think that if the worse our government debt gets, and I believe that it will get worse. I believe that investors who have a portion of their money in gold and even a small portion, maybe 2% in Bitcoin, I think you're well served by that. But I think this year is you're going to be really needing to have patience and realize that the market doesn't go up every year. And frankly, I worry more if the market goes up 20% this year, then I'm really worried in 2026. So, um, if you're working for a company that has a 401k plan, absolutely continue to put money in. If the market drops 20%, increase your contributions for a while. Put extra money in. You buy on the dips, and then just have a long-term goal. If you're 30 years old, it's 100% in stocks, and put as much money as you can away for the future. If you're 40 years old, 100% in stocks. If you're 50 years old, 100% in stocks. If you're 55 years old, start thinking about adding some bonds, some gold, some Bitcoin to your portfolio. And if you're retired, be sure that you're not taking too much risk, that you don't own 20-year bonds this year, that you shorten up on your maturities. And here's the last piece of advice. Don't look at the news every night. It'll just depress you and make you mad. You'll want to hit somebody, and that could get you in trouble. And if you're gonna, as I always say, if you're gonna watch something on TV, ESPN's good. There's always some good football on, basketball, and if not, watch MeTV and watch Beverly Hillbillies and Gomer Pyle, RFD, and let's see, Green Acres, and those shows. Laugh a little bit more this year. That would never hurt. And here's so I said that was the last piece of advice. The last piece of advice: trust in the Lord with all of your heart, and lean not on your own understanding. In all your ways Acknowledge Him, and He will direct your path. Have a great day, and God bless you.
Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The opinions expressed in this material do not necessarily reflect the views of LPL Financial.